I don't want to scare you, but this one is gonna be a long video. In this channel we already talked about some products that are strangely pushed by the financial institutions, one of the many being the funds, the actively managed funds. In this video then we will see certificates, but also we will see why people like them and also why the financial institutions push them that much. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. When we find ourselves in front of a very complex product, a very structured product, and that product is very pushed by the financial institutions, we should always ask ourselves, why? So let's see in this video why, at least in Italy, especially in Italy, certificates are very liked by savers. Of course, the first and most important reason is that the financial institutions push them a lot. When we do not understand something, we don't understand a product, especially in finance, we tend to trust someone that seems like he knows more than us. But the only thing they know more than us is how much money they make and how they buy those Rolex. Of course, it's not always like this. Many bankers are good, many advisors are good, but in most cases, unfortunately, it's like this. Certificates are a structured financial product, a derivative, very complex, a mixture of complex financial instruments, all put together to make the client not understand what they are buying. This is a perfect mix to make it possible to the banker to say whatever he wants to the client, as long as the client trusts the banker. Another reason why people choose certificates and why they like certificates is because they remind a lot about bonds. Especially in Italy, a couple of years ago, 10, 20, 30 years ago, there were a lot of bonds, very high yield bonds from the government, so very sure and certain bonds. We could even find 10% yield bonds. Well, nowadays those bonds cannot be found anymore. We don't have that bond market anymore, and so the savers and so the people, the investors, private investors, need to find another instrument to rely on certain money. And that instrument seems to be the certificates, because especially for partially protected capital, they give a very high coupon. The problem being that the risk also is unfortunately very high, and the certificate has nothing to do with a bond. I have to be honest though, even though most certificates are not good and they should not be used as investments, especially by people that are not experts, not all certificates are bad. There are some certificates that can be useful and that can be used. First of all, we need to understand that certificates are a derivative, so they derive their price by something else. And where do they derive the price? The price is a company or the stock of a company on the market. This stock is also called underlying asset. In a few words, when we analyze a certificate, we will see that the certificates will be connected to a specific companies. For example, if we go on the certificate market, we can find a certificate for Unicredit. Well, that certificate is gonna be connected to the movement of prices of Unicredit on the stock market. But who creates the certificates? Well, generally issuers that want to create them, normally banks, so Deutsche Bank, UBS, JP Morgan, and so on. Certificates are created based on options, another derivative instruments of the financial markets that we are certainly going to talk about in later videos. So then the issuer will choose which options to insert inside the container, so inside the certificate. It is important to understand though that inside the certificates we can find anormal options, so options that are not very normal. For example, strike zero. These options cannot be found for retail investors, and these are options made by banks for the banks. But how can the issuers practically create a certificate, and also where do they find the money in order to create the certificates? Well, financial institutions don't do charity, they don't do money for free, so they need a resource in order to pay for the options that they put inside the certificates. But before understanding where they find the resources to pay for the options, we need to mention that the financial institution will buy the stocks on the stock market of the underlying asset, and by doing this they will receive the dividend. With the dividend, they will pay for the options. And with this last phrase we already understand one thing. If a company doesn't have a dividend, it is very unlikely that you will be able to find a certificate on that company, because the issuer will simply not have the money to buy the options to make the certificate. Another aspect that we can already understand here is the first gain for the issuer. When the issuer receives the dividend, not all that money is gonna be used to buy options. Some of that money is gonna be retained by the issuer and simply taken as earnings. Nothing more, nothing less. And also by this we can understand what is the first cost or hidden cost or missed opportunity for the investor. The investor, if you buy a certificate, will not be able to receive any dividend. Another cost, an actual cost this time for the investor, is the price of issue. Similarly to bonds and stocks, before the certificates are put on the secondary market, they are distributed to private investors through banks. To do this, the issuers, so the banks, will ask an issuing fee that can even go up to 2 to 3%. This means that if we buy a certificate for 100 euros, it is actually going to be valued at 98 euros or 97. This is a very big cost for the investors, and that's why certificates should never be bought at issuing. Unfortunately, many investors do exactly that. Why is that? Because they go to their bank that they trust, they go to the banker, and the banker says, you know what, we have these certificates, these new certificates, buy them before the other ones do that, and issuing fee. 2-3% of issuing fee, that's a lot. If an investor doesn't want his certificate anymore, he will be able to sell his certificates to someone else on the secondary market, very similarly to bonds and stocks. This is done through an exchange. We talked about exchanges in previous videos. To access the exchange, you will need a broker or a bank. You go to the broker or the bank and you place your order to sell your certificates or to buy new certificates. We said already many times that when there is a profit, there must be a risk. So what is the risk behind certificates? The first risk is the liquidity risk. Certificates are not very famous, they are not very much used by professional investors and traders, therefore the liquidity levels are very low. When we want to sell our certificates or even buy it, we could encounter some problems in finding a counterparty that wants to take the counterparty trade, so buying our certificates or selling it to us. Fortunately, this problem is a little bit marginalized by the fact that the issuers need to guarantee at least a minimum amount of liquidity. Therefore, they will buy and sell the certificates. But in any case, if we have a lot of certificates, we will find it very difficult to sell them, and it may even be impossible to sell them. Another risk is the issuer. We said that certificates are connected first of all to the underlying asset, so Unicredit for example, but also they are issued by someone else, by a financial institution. If the underlying asset, also the company, fails, we will lose potentially all our money, and that's fine. That's a risk we can accept, and that's a risk that we have also when we buy stocks or when we buy bonds. It's nothing more than that, okay? So we can accept that. But what happens if UBS fails or JP Morgan fails? We will lose our certificate anyways, therefore our money. So we have double the risk. We have the risk of the underlying asset failing, and we have the risk of the issuer that made the certificate failing. After understanding in general what certificates are and more or less how they work and how they are created and what are the risks behind certificates, let's understand the types of certificates that we have. And so let's go in detail understanding what are the characteristics of these certificates. We have two types of certificates, the ones for trading and the ones for investing. The first type is of course for traders. These are characterized by very high levels of leverage, very low level of liquidity because not many people use them, and in general they are very risky. So they are only dedicated to experts and they should only be used by experts. Unfortunately, that's not always the case. Many people decide to use this type of certificates and they burn themselves. The second type, where I would like to talk about it more, are the investment certificates. So the certificate made for investors. This type of certificate can be divided into categories. We can have therefore two other types of certificates, the one with partial protected capital and with total protected capital. The first types of partial protected capital give a coupon which is periodic and kind of certain. They will give a monthly, quarterly, semesterly, yearly and so on coupon. The capital though will be only partially protected, so protected until the underlying asset loses a certain amount of money. Therefore, we can lose even all our money. This is a type of certificate that generally should be avoided and not used. That's exactly because of only the partially protected capital. So in this case, the risk doesn't really justify the earning. The other type of certificate is the totally protected capital. This is a much more interesting certificate because, again, the capital is completely protected. So even if the underlying asset drops a lot, the capital will be protected. In order to have this totally protected capital, though, we have to give up our coupon. So the certificate will not always pay a coupon if certain things happen. But nonetheless, this is a much more similar thing to bonds because, again, the capital is protected. This is very interesting as a certificate, especially if we can find the certificates that are based on indices such as the S&P 500. This is because it's more diversified and it's more certain and less risky. There is also another type of certificate, but that I do not want to talk about in this video because it really applies only to Italians or only to specific countries that can actually use them for taxation purposes. Since I don't know the taxation in your country and I don't know the major taxation policies, I don't want to talk about them. What I want just to say is that they are called Maxi coupon certificates, and they are used in order to have some taxation advantages in Italy. They can be used, but they need to be used with reasoning. But the major types are the totally protected capital and the partially protected capital. The most interesting one is the totally protected capital, especially if we can find it with diversified indices such as the S&P 500. In conclusion, certificates are instruments that in some specific situation for some specific investors can actually be useful, but those specific situations and those specific investors are very small amount, and probably it's not you. So if the banker or the advisor advises you to buy certificates, and first of all you don't understand what certificates are, please do not buy certificates. Do not fill your portfolio with certificates, because in this recession that just happened, we saw what certificates did, and it's not nice. It's nasty, it's awful, and it made many people lose a lot of money. So be careful and don't always trust the banker, because many bankers, actually all bankers, have their interests first and then your interest. In the next video, I'd like to talk about unit-linked policies, another financial instrument created by banks to confuse the investors and make them sign those contracts that they don't even understand. So we will see what unit-linked are and why you should not use them. So if you haven't done it already, please, I highly suggest you subscribe to the channel immediately so you don't miss out on any further video. In addition to this, if you like the video, if you enjoyed the video, please leave it a like and let me know in the comments down below what do you think about certificates. Have you ever bought a certificate? Do you plan to buy a certificate? Or what do you think about certificates in general? And I will see you in the next video. Everyone at this point now talks about the coronavirus, so let us talk about it as well. Now, I'm not a virologist, I'm not a scientist, and I'm not a doctor by all means. I'm just a guy who likes economics, so let's understand what is the possible economic impact that the coronavirus